What's going on, guys? Welcome back to the channel. My name is Mark and this is Entrepreneurial Finance. Now today what we're talking about is a rather big question, with the Fed cutting interest rates to zero, the Bank of Canada also lowering their prime rate. I kind of want to talk about whether it's a good time or not to be buying a house. Interest rates in the world are determined by a variety of factors, some that include the action that central banks take, the health of the economy, and also the rate at which people are saving money. Given that most sales of homes are financed through the borrowing of money, it's important to note where these interest rates are, and also that the housing industry is profoundly affected by these changes. The rate at which you can borrow is also profoundly affected by your own credit score. So the first thing I want to talk about is your credit score and how that is calculated. So there's 5 main factors that determine your credit score. The first one being your payment history. Okay, so that's 35% of your score, and what that is have you ever been late for a payment? And essentially they use past behavior to determine and forecast your future behavior. The second factor is credit utilization. So the more credit you have, the better it actually is, because when you actually go ahead and use your credit card, you will be using a smaller percentage of your credit ratio. A credit utilization ratio that's considered really good is usually below 6%. So if you're consistently using below 6% of your credit, you will receive a high percentage of that 30%. The third criteria is the length of your credit history, okay? So new people, let's say, that are just entering the labor market, you're 18, you're 19, you're 20, you're just getting your first credit card, you're not gonna have an extensive credit history, and your credit score will be subject to larger fluctuations early on as you don't have a lengthy history. The fourth factor is your new credit. How often are you adding credit cards? And if you're opening a lot of credit cards, this actually might signal that you are a high-risk consumer, since you need access to plenty of credit to pay off all your debt. The fifth factor is your credit mix. This one's kind of gray, and what it is your ability to pay back multiple lines of credit. So a lot of experts say it's good to have 2 to 3 credit cards actually, and pay them off regularly, just to show that you can handle multiple debt streams. That's kind of the one gray area here, but those are the 5 main categories that affect your credit score. This is going to essentially determine the rate at which you can borrow. The better credit score you have, the lower interest rate you will be offered when applying for a mortgage or to any lender to borrow. The second thing that I want to talk about is how interest rates affect the market. Now, the first thing that we actually need to talk about is central banks and their role in the economy and ultimately determining the target interest rate. As I mentioned earlier on in this video, the Fed, which is the American central bank, has reduced their target interest rate to 0, and the Bank of Canada has reduced theirs to 0.75. What this does is essentially encourage lending, it encourages borrowing, it encourages spending, it encourages business investment to ultimately boost asset prices. So the role of the central bank is to raise the interest rate when the economy is strong and lower the interest rate when the economy is sluggish. Now, they have multiple tools available to them, central banks that is. You have open market operations which they can use, you have the discount rate, and you also have the reserve requirement. These are fairly complex tools, and we probably won't go into them too in depth in this video, but this essentially forms monetary policy that the central banks can use to change their target interest rate. Lowering rates makes borrowing cheaper. As I already mentioned, what this does is incentivize spending, it incentivizes business investment, and ultimately boosts asset prices. So pretty much interest rates determine everything. It's also important to note that there's multiple different types of rates which you can apply for when applying for a mortgage. You can take the fixed rate route, or you can take the variable rate route. Now, fixed rate is a fixed mortgage payment over the lifetime of the mortgage. Often you're able to refinance this or renegotiate these terms after 5 years into, let's say, a 25-year mortgage. So you might start out with a 25-year mortgage, let's say at just a 3% interest rate, and 5 years in, you got multiple promotions at your job, so did your wife, fiance, partner, whatever that may be, so you can refinance and actually negotiate for a lower rate. Variable is a little bit trickier to value, but usually what it is the prime rate plus 1 or 2, depending on the agreement or contract based on your credit score. The important thing to note also is when you go with a variable rate, you can change at any point over to a fixed rate, but if you go with a fixed rate, you cannot actually transfer to a variable rate. So variable rates are often higher risk because you don't know what's going to happen in the economy. You don't know if there's going to be any sort of black swan event like the coronavirus like the oil price wars between Russia and Saudi Arabia. So variable is much more risky, but you can end up saving money in times of economic duress like right now. Now we also have to talk about how interest rates are going to affect the price of houses. So what we're going to do is we're going to talk about Economics 101 here, and I'm going to go back to my university days and draw you guys a price and quantity graph with supply and demand. Okay, so anybody that has graduated university with a business degree should probably know what this is. On the vertical axis we have the price, on the horizontal axis you have the quantity demanded, on this line here you have the demand, and on this line here you have the supply. Okay, so currently this equilibrium price and quantity demanded is right here. Okay, so let's call that Q0 and let's call this P0. Nice and straight, okay? So what we're likely going to see here is an increase in demand because rates are so low. Why would you not want to buy a house currently, okay? So we're going to see a shift in the demand curve to the right. So what does that do to the equilibrium price? We're going to see it actually increase the price because the equilibrium price is now higher, okay? So this is P1, and you can see it has increased from P0, and the quantity demanded, or the quantity, is also going to be higher. As demand rises, we are going to see increased prices. The question is, what's going to happen to the supply? Now, obviously, if supply goes down, we're also going to see an increase in prices. Okay, so that's probably kind of hard to interpret. You know, maybe I'll put up an actual picture of quantity and demand, or supply and demand chart. But basically, as supply gets lower, you're going to see increased prices. I don't think we're going to see a decreased supply, but we will definitely see an increased demand for new housing purchases. It's also important to note how you actually value a house as a real estate developer. The main valuation approach is the income approach, which is actually very similar to a DCF. For those of you who don't know what a DCF is, it's a discounted cash flow valuation. Okay, and instead of using the required rate of return or the weighted average cost of capital, what you use is the capitalization rate, which is essentially your discount rate. Okay, so when you have these streams of income and they're coming in, let's just use $1 for now. How this works in a DCF is you have your discount rate, which is going to go on the bottom, and what it is it's 1 plus your rate to the power of how many years in the future that you're discounting. Okay, so how that ends up working is, let's say your fixed income payment is 1, just for the sake of simplicity for this video. You go to the next year, it's going to be 1 plus R to the power of 2, and so on. Okay, so 1 plus R to the power of N, all the way into the future. Okay, so you have a value into perpetuity that you're expecting to receive as payment for this household, your mortgage essentially, and that's kind of how you determine the price of a home, or at least how most sellers determine the price of their home that they're either renting or selling on the market. And like I said, similar to a discounted cash flow valuation, R is your discount rate, or in this case, for the sake of real estate, we're talking about the capitalization rate, aka discount rate. So this brings me to my third topic. I want to talk about the current low interest rate environment and why it's going to persist. Over time, there's been no clearer link than long-term economic growth with long-term interest rates. The lower the interest rate, the greater the growth. The higher the interest rate, the lower the growth. It's very self-explanatory. What we're kind of seeing now is monetary policy being broken worldwide. We're going to get into negative interest rates in the next segment, but the question is, are negative interest rates coming to North America? What we're seeing is this notion of helicopter money, okay? You see the Fed printing all this money, the president announcing that everybody's going to be getting these checks while they're unemployed or while we're stuck at our homes for the sake of this virus. And that's crazy. I've never seen, and I doubt we'll ever see ever again in our lifetime, any central bank print $1 trillion or spend $1 trillion in the repossession market on a daily basis. That's crazy. Now, obviously, lower rates equal more sustainable debt. That's why we've seen US debt or North American debt, Canadian debt really balloon in the last few years, or as time goes on, it just continues to get higher. At the same time, the interest rate continues to get lower, which actually makes this debt more sustainable. Now, capital shock should also rise relative to output. A lot of investments that didn't make sense prior, like let's say upgrading a road to save a few minutes of time or spending a couple extra years in school to make more money are now worth your while, okay? So capital shock should rise relative to output. These aren't projects that are no longer irrational. They're very rational now. Also, any assets with a fixed supply will rise in value because interest rates are now lower. For instance, if you look at utility companies, let's say a monopoly supplier of water, the capital value of these assets must rise so that their yield matches the lower interest rate. Housing demand will also inevitably rise. Why wouldn't you want to buy a house when interest rates are at an all-time low? So you're going to see this initial surge in housing demand. Question is, when will that price normalize over time? Lower interest rates also make it harder to save. The people that are getting punished are the savers, and the people that are being rewarded or the gamblers, which is kind of horrible to say if you think about it. So let's say you have investments and you're investing in a money market account, which is usually the risk-free rate. For instance, when I started my investment account, my money market yield was just below 2%. And now, since the Bank of Canada has actually reduced rates, my savings are actually only yielding 1%. So savers are getting crushed, gamblers are being rewarded. At the end of the day, economic data is or should play a big part in the central bank's decision. For instance, in the US, the Fed is supposedly independent of political pressure. But as we've seen, President Donald Trump is all over Jeremy Powell to cut interest rates to zero, and that's exactly what they did last Sunday. Higher rates would ultimately negate or discourage economic growth. So the question is, are we actually headed to negative interest rates in North America? Which brings me to the fourth segment. What are negative interest rates and how do they work? Negative interest rates are a very unconventional monetary policy tool and something that's actually a fairly new phenomenon to this world. What they're used for is to stop a deflationary spiral in economic growth. So what you see during these times are dropping prices, you see tons of job losses, and you essentially see no growth in the economy. So what central banks do in this case is target negative interest rates. What this has been doing is kind of counterintuitive to what has actually been going on. So I think when people see that central banks are going negative with their interest rates, they see that the economy may be peaking, and it actually drives fear and promotes them or incentivizes them to save and hoard cash, which is exactly opposite of what the central bank is trying to do. The central bank is trying to stimulate growth, they're trying to stimulate spending, business investment, and ultimately boost asset prices. But what it's really doing is just scaring people to save more money. If you look around the world, negative interest rates are already prominent in Europe as well as Asia. Like I said, the real question is, will negative interest rates be coming to North America? I really think that depends on the US election come October, November. We currently see very expansionary measures, a very expansionary stance in the US with President Trump. If President Trump's going to win that election, I expect that we'll continue to see that. I have no idea what kind of stance any of the other candidates might take. Obviously, they want to help the economy, but we don't know to what extent they will pressure the Fed to cut interest rates. Okay, so back to the initial question, is it a good time to buy real estate? Like I said, there's going to be this initial surge in demand, which is going to boost the prices of houses, and that's going to take a little bit of time to normalize. How long is that going to take? I'm not sure. It could be months, it could be years, but it's never really a bad time to get into real estate. Real estate is usually seen as a good long-term investment. Timing the market is also pretty much impossible. If you're a seasoned investor, that's what most people will advocate for, not to time the market. Just to get in when you can and make the best of your own scenario. So obviously you need to look at your own risk tolerance, you need to look at your own personal finance goals, and you need to make sure that you're making the right decision for you, because the answer for you might not be the same answer for me or somebody else. At the end of the day, mortgage rates are never going to be zero because a credit-worthy consumer will never be able to borrow at a lower rate than the US government. US Treasuries are currently at all-time lows, and that will certainly drive down the interest rate for mortgages. I hope you guys enjoyed this video. If you did, don't forget to smash the like button, share the video with a friend if you learned something, and don't forget to like and subscribe. I'll see you guys in the next video. Peace out.